Okay, welcome to our price level discussion group. This week we're talking about a blog post by Jens Nordvig entitled "The Big Myth About Money and Inflation." So he's talking about the fact that there isn't a simple connection between the amount of money out there, the money stock, and the price level and inflation. So there's kind of this assumption or kind of this kind of default common belief in monetary economics that the price level is kind of strongly connected to the amount of money out there. If you double the amount of money in the economy, that doubles prices, et cetera, et cetera. And of course, that makes intuitive sense. I think you and I have been reading some Gurley and Shaw lately, and I liked their approach of starting with explaining how the kind of mainstream model works, this very simplified model, and then saying, oh, if we, at a theoretical level, if we change just certain variables or certain assumptions, then you get a different result. So I felt like that was kind of starting with something you know and understand, and then changing something into, making a minor tweak and having it still be something you know and understand, and showing how the outcome is different. I felt like that was kind of intellectually more satisfying than maybe, oh, hey, Stefan, how you doing? I thought that was maybe, you probably can't hear me yet. I thought that was maybe more intellectually satisfying than starting from like, well, wait a minute, are these things really closely connected? Let's go look at empirical data. No, it's not. This is a big mystery. What are we going to do about it? Kind of approach. But I can, and then, this relates to our Richard Vague discussion where he says, like increase in the money supply does not cause inflation, that kind of stuff. So there's a couple things I want to establish right at the beginning semantically, which is that, when Jens and a lot of people are talking about the money supply, what they really mean is the stock of certain measures of how much money there is. So that depends on what we define as money, what we're going to include under that umbrella. Not all assets or wealth that you hold is money. Not all forms of credit necessarily are money, but where you draw the line might be somewhat arbitrary. Which things are more actually used to settle payments and which things aren't, that kind of thing. So there's that. So when he says money supply, we mean money stock. And then a lot of times when people say like, oh, money matters or something like that, what they're really saying is, there's that the money stock is what matters, right? It's not, so there's kind of this loose language around money, like money supply, money stock can all mean the same thing, depending on, kind of what context in which you're having a conversation. And I think we would all agree here that money matters, of course, and money matters for inflation, but we might not be defining money implicitly as, oh, the money stock, right? The money stock is what money is or something like that. So I wanted to kind of establish that at the beginning. So even if we go into the article, we can kind of translate what he's saying into more precise language. And yeah, so I think, there's a question of what is money doing, right? If money is just sitting around, then obviously it has nothing to do with prices. Or if it's buying things that aren't, in the basket of goods that we use to measure the price level, then it has nothing to do with the price level as we think about it. So it matters what the money's doing. There's a concept in my mind that I've kind of termed the productive slice of the economy, which is the part of the economy where the goods, the real output of the economy is flowing in one direction and money is flowing in the other direction. And if you're literally saying, well, what's the amount of goods, what's the quantity of goods flowing, and what's the quantity of money flowing, then that implies a price. It implies a price level, right? So you can't really say that the price level isn't connected to the amount of spending that's going on in that particular, kind of slice of the economy that you hone in on. So that's something we can start with. Like, we understand what's happening there. There's a flow of money in one direction, a flow of goods going the other direction. The balance between those things is going to determine the price level. So those are some thoughts that I kind of wanted to start with. The blog post is short enough that if we wanted to, we could literally read through it while we talk about it and kind of go through it paragraph by paragraph. But I'm curious to hear you guys' initial thoughts.
Yeah, first of all, hi, Stefan. Good to see you. Where are you?
He's in the sun.
Oh, I'm at a friend's place, so in Nuremberg. So I just dialed quickly in. Yeah, so I
Nice.
have half an hour. I'm sorry. So, but
fine.
it's nice weather and it's balcony, so I moved here.
Nice. No sun in Berlin, unfortunately. So just to hop on, since you mentioned Gurley and Shaw in our discussion, it was yesterday. I can't even put the days together. So one, yeah, we can look at this. I agree with everything you said. I think there's a clear sort of, there's no clear line. He's making the point between, whatever the definition of money stock and inflation. And I think the clearest case for this claim that this relationship doesn't hold is, of course, advanced economies. He did drop in one table. This was an IMF working paper, IMF study, the modern inflation cycle, which establishes that money stock does have a much more significant influence for developing economies. So let's just connect it with the discussion yesterday with Gurley and Shaw, and also with our own intuition a little bit of what we established in previous session with Vig, which is that financial deepening kind of matters here. So it's not just the amount of money in the system. In a simple economy, when we only have money for payment, then yes, it's immediately it might immediately reflect in a very simple monetary economy. I think the amount of money immediately might have a direct impact. But the more financially deep, if we now add, the type of additional markets and market depth that Gurley and Shaw were starting to describe, that we also know exist in our modern economy, then it's much more of the story of, yes, private credit exists, but it is, asset and liability at the same time, and therefore also something else happening that's no longer money in transaction with the retail economy, if you will, or whatever it is. So we're not touching that intuition anymore that was established, whenever we didn't have this financial deepening. So yeah, I agree with the statements. I don't think he went very far in this analysis. Just look at the bird's eye. It wasn't like just basically 2 or 3 points. The one point you already mentioned at the beginning: money does not introducing new money stock does not mean inflation. He sort of caveats this with the intuition we also know already from Vig and from others, that this has actually been, and also actually Stefan's your blog post, your study actually establishes this too, saying this is actually not new money, it's public money replacing private credit that has been created essentially. So that's the primary thing. It's also what he says here in this blog post. But he makes one additional point, which is the second point I already mentioned was, yes, there's a in less financially deep economies, it has a greater effect, which also is within our intuition that we already established. But the third point, which is sort of the interesting one, is that he starts distinguishing between the asset swap story that we already know and sort of this retermed fiscal policy. So pure monetary finance or pure injection from a fiscal authority into the economy would potentially be inflationary, he thinks. Why? And because it creates additional demand, probably in the retail end of the economy. So these are the 3 main points I took away from the blog post that we might want to discuss. And I didn't see anything in the comments either that would really be worth bringing up, but those are the 3 points I think that were interesting.
Yeah, and it's interesting with the asset swap argument for quantitative easing. It's also the case that when the government is deficit spending and the central bank is buying that debt, the action, if you isolate the action of the central bank, it's still the same thing. It's still swapping one asset for another in the private sector, right? They're swapping the treasuries for base money, right? So that action in itself is, that can affect inflation. It can affect the price level because you're swapping, kind of an interest-bearing treasury for something that's the means of settlement for reserves, right? And that affects I guess traditionally that affects the amount of reserves in the system and makes it cheaper to borrow reserves. I guess we don't. That's more complicated now that there's so many reserves and we're paying interest on reserves and that kind of
But
stuff.
what does he mean by QE is mostly an asset swap? I really don't understand it. I mean, so reserves are liabilities, at least formally, right? Even if you can say it's stupid. And then he says that they're mostly an asset swap. So I'm not. So I very quickly read over the blog post.
Yeah.
But so I didn't really see how this is a relevant conclusion. I'm not sure.
I think the argument that he's trying to make is that assets are roughly interchangeable with each other with respect to some, effects that or some outcomes that you might expect. So it's not going to have that much of an effect or something like that. I think that's kind of what he's trying to say. So I have an asset, the central bank is swapping in cash for that. And now I have another asset. Does that really make a difference? And I think, here we would argue that yes, it does make a difference. And the specific example of replacing swapping a treasury bill for reserves is kind of what I was getting into there. And I was trying to highlight, there's two channels by which swapping, giving the private sector reserves in exchange for treasury bills is going to be inflationary or is going to be
so just to understand his terminology. So then the next things that he says, this is fundamentally, so QE is fundamentally different from a situation in which money printing is used to finance government spending or tax cuts. I'm not sure I follow him. I mean,
right.
so he says that so to him QE is not money creation or at least not printing in a physical sense.
I think he's drawing a line between fiscal expansion versus fiscal policy expansion versus monetary policy expansion, or fiscal stimulus versus monetary stimulus. So on the one hand, you could have the government running a deficit, which introduces new money into the economy. And then the only thing, or introduces new assets into the economy, it expands the balance sheet of the treasury only on the liability side. So it expands the balance sheet of the private sector only on the asset side, whereas monetary policy is swapping one asset for another, or if you're on the balance sheet of the central bank, just swapping one liability for another. Does that make sense?
Follow him there. Yeah, I mean, I guess I have my understanding. I mean, so when the central bank buys assets, bonds, they to a large extent they are government bonds, right? So I mean, then I don't know. To me, well, this is obviously the QE is an expansion of the central bank balance sheet and to create more reserves as liabilities. So this is just one way of. So to me, this is very obviously money creation.
It's the difference between expanding the balance sheet on both sides versus expanding it on one side. So the central bank is always going to expand and contract on both sides, whereas the fiscal authority might issue new liabilities into the economy. I think that's the distinction he's trying to draw. He's just not being sharp about defining what he's talking about, because obviously
there are just so many like stories and representations about QE and what QE is and what is not, and I'm just I always take it with a grain of salt, and at least I try to understand what's the frame that the people who are writing about QE, what are what kind of concepts are they using, and so that's. I think this is just too short. Well, just a blog post to really dig deeper into his framework there.
Yeah, so there's two ways we can approach this. We can use what he says to inspire us to think about what we're thinking about, or we could try to kind of really drill down into what he means or what he's trying to say.
So may I ask, what was the main motivation to choose this as the reading for today?
Well, I should ask Jay because he's the one who suggested it.
Okay.
Yeah. I just knew that he was thinking about this, and I never actually read it in any detail. I just knew from other people that he was thinking about inflation, and he had. When we were starting to think about this question, it was clear that why haven't we seen inflation in the past? It was sort of in the same virtual rate conversation. But I think if the one question that I mean, I don't see anything fundamentally deep here that's super. But I think we go with this intuition. I think you're right. I think Alex agreed with this last distinction. Like, he doesn't talk about balance sheets, of course, but I think he is sort of introducing, like, are you buying existing assets, financial assets, and swapping? Basically, that's the one operation. He doesn't see that as inflationary, apparently, versus somehow introducing only the liability, in quote unquote, into the economy. I'm not sure how that technically would actually work, but I think if that's the frame, that's how people think about this, then it might be inflationary. And he's thinking about that actually being a policy tool with his fiscal policy, whatever he calls it. So, but the question that came to my mind, if we adopt sort of this sort of loose frame of, okay, like asset swaps versus, you know, introducing new spending into the economy from a fiscal authority. I was thinking about this also yesterday in the other conversation we had, which was, to what degree did the central bank, you know, the QE programs, the asset price purchasing programs, to what degree did they contribute to a relatively non-inflationary situation? Also, what would happen, and maybe the other question would be, what would happen if we started unwinding them? Like, what happened if the Fed and the ECB started unwinding these big balance sheets? How would that affect the price level inflation, that conversation? Because that's something I have not really fully taken in as something like, okay, we still have these massive amount of assets somewhere that's not being priced in properly in some place. So how would that work? So we might be back in another conversation if that were an objective of a central bank to do that. So I'm not sure what you guys think about that that potential scenario.
Yeah, it's an interesting question, because unwinding it, of course, is also an asset swap, right? So if you think asset swaps aren't going to do anything, then you think, you know, going the other way isn't going to do anything either. I think in terms of unwinding it, there's another thing we can notice, which is that if they don't unwind it and they commit to never unwinding it, then do they really have those assets on their balance sheet anymore? Conceptually, does it really even matter, you know, whether we think of them as having those assets on their balance sheet? Or then does it start to look more like, okay, maybe they only, you know, introduced you know, new liabilities into the economy, and what they bought up were really worthless assets. So they swapped, they bought these valueless instruments and replaced them with something that had value. And then maybe that actually does look like something that Jens Nordvig would think of as more inflationary or something like that.
Have you guys had a look at the QE report by the House of Lords?
No.
Have you heard of it? So they had this kind of, the House of Lords had like a big inquiry. So they invited a bunch of experts. So I knew it because like one of my co-authors actually also reported there, and they just launched it like 1 or 2 weeks ago. And I just looked at it. So they also have quite a bit about inflationary impacts of QE. So I guess if we want to look into that, that could be something interesting to read.
Yeah, that could be a cool thing to discuss. Is that an ongoing thing that's happening right now, or did they just release it?
No, it's like a parliamentary report by the House of Lords on QE, and I think they're very critical. So quantitative easing, a dangerous addiction.
Let's see if I can find that.
I mean, the question. I think the question about like inflation and QE is certainly interesting, and I guess a lot of things have been written about it, and there's probably stuff that goes a bit more into depth than now this very like quickly pitched blog post by Nordvig, right? So that's why I think it's actually a broader question, and we could also try to approach from a systematic perspective.
Yeah, and you could also ask the question, what's the intention of QE? You know, what outcomes are we trying to achieve with it? Is inflation one of them?
You want to create more inflation, right? So
well, not necessarily. You might just be trying to backstop capital markets so they don't collapse or something like that. So that, you know, the financial system doesn't collapse.
I think, but as long as you call it QE, so my working hypothesis is once you call it QE, you say we actually have to create more inflation because we have an inflation target and we're at zero lower bound, so we cannot reduce the interest rate more, and that's why we need to expand our balance sheet to still. So, I mean, at least put it this way. For example, the ECB has to use that argument because all the ECB is ever able to do based on European treaties is provide for price stability, which then means increasing inflation, right? So that's why they do it for inflation.
And that's what they announced today, basically. And it's interesting to see also in this blog post, Nordvig's blog post, he also says that basically all these massive Japanese purchasing programs, asset purchasing programs, have not led to the intended inflation. So the model that they were following in order to achieve some sort of inflation has not worked in that direction fully either. So there's something else there that we need to unpack, which is yeah, again, the argument that's been creeping up is, okay, maybe this is not a central banking task to try to intervene in this way. There is maybe this has to be in an actual fiscal authority, like actual cash needs to be injected, the cash flow needs to be injected into the economy, not just, Perry likes to say, central banks only can change the conditions, they cannot actually create real cash flow. Or primarily, that's not true. Primarily, a central bank changes the monetary conditions, hoping to nudge and induce others to change their behavior, whereas the fiscal authority can actually typically spend with direct cash flow into the economy. And I think that's something that we've been that's an argument that's been brought up again and again. It seems like that's also in the background here with Nordvig when he's talking about, because the fiscal policy frame and him talking about money being printed and then put into the economy sounds like he's making that distinction for sure as well, and that could be an inflationary, great financial inflationary dynamics.
I just want to comment that just because we don't observe inflation in absolute terms with QE doesn't mean that it isn't having an inflationary effect, right? We don't necessarily know what the counterfactual is. Like, would we have had massive deflation if there hadn't been QE, that kind of thing. So it's hard to draw conclusions about, what the effects of something are relative to what would have happened if you hadn't done it, unless you have more of an actual theory of what's going on, right?
Yeah, sure. I mean, this is the basic problem of all these kind of social sciences, economics, right? That you just cannot run several rounds of experiments under the same conditions.
Yeah, exactly. But yeah, I mean, I agree with you, Stefan, that that the term quantitative easing semantically, it implies that you want inflation, right? You wouldn't be calling it that if you didn't want it. But I think
I have a half-baked QE paper that I just presented like at some point. I kind of lost the question, or I don't know. So I just I read that. So I mean, the Fed did QE, right? And I understand that when they started QE, that was basically after this backstopping, right? So the kind of backstopping Perry's story, deal of last resort, is actually something else than the QE, even though it often gets confused. But I mean, there's not much time in between it, and it's still the same, right? They just buy up stuff and expand the balance sheet. And then in Europe, there is like this QE story. The ECB was later to start, and they didn't want to call it QE first. And then the question is, what do they actually buy? And yeah, so sometimes you read QE is always like just public debt. Sometimes you read it's private debt. I mean, it's both. I think in all the major central banks, it's a mix of both. And then what I was interested in, does it make a difference if they buy public debt on the primary market or on the secondary market, right? Because I think in Europe they can't buy it on the primary market, right? I think in the US they probably can. But by now I think, I mean, it's the, using Perry's language, is the difference between payment and funding, right? If you buy it on the primary market, then yeah, okay, they like Treasury and central bank are the direct counterparties. If they do it on the secondary market, they need to have like a bank in between that acts as primary dealer. But I don't think it makes so much of a difference in the end, right? It's still balance sheet expansion at the central bank, and they create reserves. And if we say reserves are money, then it's money creation. And you have the treasury balance sheet that also expands. And yeah, so you also have a fiscal expansion, right?
Yeah, and I think the difference between payment and funding has to do with does the credit stay on the balance sheets or does it shrink back down? And if it stays open, if the balance sheet stayed expanded, that's a funding position. So I think it's all
which credit exactly do you mean?
I mean, do the balance sheets stay expanded after the operation, or did they just expand temporarily
for some time, right? But they would then shrink back usually, right? So I mean, but then you roll it over. This is how I understand it.
Yeah. So if you're rolling it over, then that's analogous to kind of ongoing funding of a position.
Exactly.
Yeah. But so I don't think this is a payments issue. I don't think either one is payments, and I think whether you buy it on the primary market or the secondary market, you still end up in a kind of final position where the holder of the asset is kind of the funder, is financing the issuer.
I would agree, but tell this to the European treaties that basically say if you buy it on the primary market, it's like disastrous and inflationary, and if you do it on the secondary market, then it's okay.
Yeah, we try to stay away from that subject when we hang out, me and the European treaties. Yeah.
Yeah, but I mean, this is all about inflation fear, right? I mean, this prohibition of primary market purchases. I mean, it's like the old money creation is inflationary basic quantity theory, and so that says we shouldn't do that. So that's why, but it's a super hot potato, right? I mean, there were like constitutional court cases.
But my intuition is that primary market, secondary market doesn't really make much of a difference. Maybe there's a little bit of friction if you force the central bank to buy in the secondary market, but that's about it, right?
If you just look at which balance sheet expands, which I guess is a very reasonable way of thinking about it, I would totally agree.
Yeah.
You just have like some banks in between. So if you only allow purchase in the secondary market, you have some banks that make a lot of money for just things that are not really necessary.
That is an important difference. There's some dealers who pick up something along the way. Yeah.
It is a political argument. I think it is to protect. I think the Fed is also probably. I mean, every central bank is trying to stay away from where people are looking, basically, and if the Europeans are all obsessed with this being burned in the old way, like monetary finance stories, which is exactly what this looks like, and no matter if it's correct or not, I think it's much easier just to stay away, one market removed, one layer down. You can easily do the same operation without having to defend something that's politically very, very difficult to defend. And I think that's right. So the interesting thing here too.
So before Stefan has to go, I want to figure out what we want to read for next week, or what we want to talk about next week.
I also wanted to apologize that I missed last week. I kind of the change of time. I just missed it. I wasn't home.
That's all right. So are we interested in reading this House of Lords report on QE? Yeah, is that what we want to do? Okay.
So if you're reading that anyway, Stefan, if you're interested in that, we can just.
I skimmed through it, but I don't know. I wanted to read it, and I think it would be a good occasion to look. It would be a clear angle that we have, and I think it's good to bring us on the same page of it. And I don't know. I just think that's. I mean, that's a carefully worked out document, and I think it's politically influential, right? I think I mean, a lot of people whom we know and probably like contributed to it, so I think it's good to just know what's going on.
Cool. All right. Let's go back to Jay. Continue what you're about to say.
That's fine.
I will say goodbye then, because people are waiting for me.
Thanks, Stefan.
Talk next week. Bye-bye.
Yep. All right. Bye. That was nice, Stefan, to stop by. And we got something for next week too. Yeah. So the one thing I was gonna just ping was to what degree, I'm not sure, I lost my train of thought a little bit, but to what degree the assets that are in circulation are being used by others as means of payment. So if we could go in this sort of distinction, like if it really matters, what you said earlier, payment in the retail sector might have a chance of showing up in CPI. To what degree do the assets that are in the system actually get used as means of payment versus not, and by whom. And I think that's something that we have been dancing around a lot as well. And I think my assumption is is a lot of these assets are not really, even if they get used as payment or they're accepted as payment, they're not used for actual retail operations ever. And that's the main reason why, yes, there is an expansion. It does matter. There's a lot of stuff happening between different actors, but it's only really like the liability of a bank and not the liability of some other, some security that can actually be used as means of payment in this huge expanded bucket of assets that are available to the actors that are holding them.
Yeah, and my sense is that people, when they decide how much spending to do, how much stuff to buy, they're not making that decision based on how much liquid cash they happen to have. They're making that decision based on their overall wealth and income and that kind of stuff, and then they're getting the cash as needed to be able to make the payments. So I think the mechanism by which all of this stuff affects spending in the economy, affects the amount of money being spent on buying the economy's real output. I think it has to do with, well, how it affects people's incomes and how it affects, not like, but I mean, the makeup of the various assets matters insofar as it affects like credit conditions and how much, businesses are spending and hiring people and that kind of stuff. So it feels more like it's about the price of money affecting the flow of credit and the flow of payments rather than just the amount. So the quantity matters, but kind of in this indirect way that affects the price. You can of course go the other direction where people's this is the money demand thing where however much wealth people have, that implies a certain money demand, and then that's kind of in the other direction. So there is this kind of link, but in terms of like the causal chain or the transmission mechanism, it's not just like, oh, are my assets, do they happen to be in the form of cash, therefore I will spend more, or something like that.
Yeah, and as we're talking, there's another thought that I had, which is obviously we're talking about consumption in very loose terms, consumption versus investment. Like, is this asset actually going to stay in the economy, or is it, whatever consumption is actually, then it sort of gets consumed? And the question we could also ask is, in a sense, if assets by themselves are, of course, more going to be in existence, and they will retain some of that, they will have some of that store of value, and say they absorb the kind of effect that you might see in an inflationary dynamic, whereas something that's being consumed obviously needs to be replaced. So that there's something that I was just thinking about this aspect. I'm not sure if it makes any sense in this context to think about this distinction, but the fact that people are holding, like most of us are holding assets, but we're not consuming them, versus actually consuming things. I'm not sure if that makes an actual difference.
Well, in terms of the money going to claim consumer goods, where the consumer goods go. The consumers eat them or use them up or whatever, right? But where does the money go is an interesting question we could ask, because kind of if we're just looking at that slice of the economy that I was thinking about, or that I was talking about earlier, the goods have a source and a destination, the money has a source and a destination. But then if you expand beyond that slice, it gets a little more complicated, because the goods get destroyed and the money kind of doesn't. It has to go somewhere. I like to think about the flows of money as having kind of sources and sinks. So any slice of the economy you look at, you're going to have money flowing in from certain sources, and then the money flows out somewhere, and it goes somewhere to different places. If you look at the whole private sector, you could say that, and if you take money to be just cash, then one sink of money could be, taxes. Another sink could be, purchasing treasuries, right? But if you expand your definition of money to include, close money substitutes like treasuries, then that's not actually a sink, but it does change, what people do with their money, because now that money has been transformed into an asset that maybe people are happy to hold on to and just sit on, and it's not contributing to spending anymore, or something like that. So there's, depending on how you slice it, there's different ways to look at it.
Yeah, and these emergency programs, obviously, when we're talking about replacing the asset swaps, being replacing things that are primarily payments, but also store of value with other money assets in that were whatever else, like whatever security. It is sort of intuitive to think, yes, there is some way that the payment aspect, the fact that you now can use this money to pay, would contribute to inflation potentially. But it is an asset swap. I think that argument is super important to sort of see, okay, this emergency measure is only swapping out a private credit. It was also money, whatever, with something that's now high-powered money. And it helps on the margin because those people are now all able to meet their payments. They don't have this liquidity problem of liquidating, make sure they have security on that front, but they also have something that is, yeah, so fine. So that's I'm pretty clear on the asset swap. And I think the argument you raised about where does the money go after things are consumed, I think that's a very valid question to think about. And we should also think about, this is actually going back, if we want to bring in another conversation, is like the IMF talks about the marginal propensity to spend, the old sort of Keynesian argument, which is, and that's the IMF being critical of inequality because the people that are holding money now, obviously the rich, with increased inequality, are less and less inclined to consume, doing exactly what would lead to an inflationary spiral. So we have another angle of inequality contributing potentially to the lack of turnover and money just being parked in assets and not doing anything. So I think that's already 5 or 6 years old with that big study the IMF did, but this sort of marginal propensity to spend has also been decreasing, I think, and might contribute to the story we're telling here.
Yeah, and if we frame it in kind of like the source of funds, use of funds framework that Perry brings up sometimes, you could think of rich people sitting on their money as like a hoarding of cash or an accumulation of assets. So that's kind of a use of funds, right? It's a sink for the money, and that's a problem if what you really want to do is you want to connect up that sink with another source, right? You also want money to be coming off the pile and going to people or something like that. But if you don't care about that necessarily, you could just say, oh, well, money is all going into this pile over here. That means we need a source of money to continually be flowing, and then that's sustainable. So it's not. I think there are various reasons why people accumulating a lot of money is a problem, or could be a potential problem. But if you're not shy about, or if you don't care about, you're happy to replace all of the lost money, then that's not one of the problems that it's going to cause. It's not going to cause there to be less money out there, because you can replace the lost money with another source, right? More government spending or something like that, right?
Yeah. Yeah. Interesting. By the way, I'm just trying to see, I was trying to Google the report that Stefan was mentioning about House of Lords.
He linked it in the chat.
Okay, didn't see that. Okay, now I see. Okay, cool. Yeah.
So I guess, yeah, I guess what I was just saying is that rich people accumulating money doesn't have to deprive the rest of the economy with money if you are happy to replace that money, I guess is the short way of saying what I just said.
Yeah. I think that's right. And I mean, it goes back to the argument you were saying. It's about stable spending that is introducing stable spending, predictable cash flow in the economy that actually is geared towards consumption, not investment, which is actually kind of interesting, partly because it's also about the type of assets that's currently being built, right? What kind of assets are actually being introduced currently into the economy? We also have asset buying programs in the private sector, if you will, right? Instead of real investment into productive structures, we are actually we've got stock buyback programs. We're keeping the assets high and potentially dividends. So I'm just wondering if that also plays a role here. There's something around the whole corporate sector that's sort of it's really, I mean, I think we're also all consuming, maybe we're consuming less. I'm not sure what overconsumption is. Is there some sort of consumption and everybody's so focused on equity building, which is of course the completely opposite story from what we're telling here. So there's might be sort of a certain, the fact that we've gotten richer, or that we have gotten richer as a society, both in terms of inequality, at the top end, but also in general, might mean that you don't spend 80% of your income on consumption, but more and more over time, the entire society to a great deal is spending more. And that might be true for even relatively poor people, right? I'm not sure.
Yeah, it's an interesting question because it kind of brings up, well, what are we, when we're measuring the price level, what are we measuring the price of, right? Assets are not included in the market basket, right? So a lot of times stable consumer price level corresponds with asset price inflation or asset bubbles or something like that. And that's kind of somewhere money can be going. And then we can ask the question, in terms of the financial assets, to what extent are those financial assets funding, the formation of productive capital, like real, so that we're boosting our economy's real productive capacity, and to what extent are they not? To what extent are they kind of just, speculative bubbles or something like that? And I think to kind of connect up the consumer spending side with the investment side, if we are stimulating the financial sector for the purpose of propping up consumers, for the purpose of ensuring that there's no deflation of the consumer price level, then we're not stimulating the financial sector for the purpose of productive investment anymore. So that's an interesting kind of contradiction in monetary policy, right? Because the Fed has a mandate to maintain a stable price level, and that's a stable consumer price level. And the way they do it is by stimulating the banking sector, the financial sector. Now you're stimulating the financial sector for a reason other than ensuring productive investment. You're propping up consumers, right? So I think that's a problem, potentially.
Yeah, and I was just thinking about something similar too. I think you're onto something. The other thing is like this whole, again, the international story. I'm thinking about primarily US, China again. The fact that investment did happen, it happened in China. There's been a huge investment boom in China, of course, in productive capacity. Typically, such an investment boom would crowd out. You would have to bid up the input factors, which it did happen, but it was still so marginal in the US terms that it didn't really matter. At the same time, this effect, because these are also US companies or companies that are dealing in the US or in the West in general, their balance sheets or their assets have all increased in value, even though the investment has not happened in the US proper. So this is kind of a weird dynamic. I've not thought about this exactly, but this has also led to, I think the general story, if I had to sort of crudely characterize what's been going on, it's not investment for productive purposes, especially not in the US. It's more like creating opportunities for intermediating between existing cash flows. I think that's kind of trying to grab rent seeking in general, right? It's like trying to sort of be, there's a lot of rent seeking happening, and that's primarily also what tech does, right? I think tech, is, in my view, is not necessarily doing a huge job in increasing productive capacity. To some degree it does, but to a large degree it also gets in the middle of existing cash flow that already might have happened between two entities. And that's sort of what used to be credit cards only. Now it's platforms of any kind, like any app, you spend 30% on the host of the app, or so like Apple Store and whatever, iTunes. And that's sort of the phenomena too. And that's sort of that doesn't require huge capital investments to maintain that. There's an initial investment, you have 10,000 people working on it, and that's it. So at the same time, these people who are receiving this money, who are receiving these revenues, are not going back and consuming it. So where is that money? That's all asset price inflation on that level. That doesn't retained earnings. What are they doing with the retained earnings? Nothing really, right? I don't see Apple buying a huge new headquarters. Maybe that's one thing they're doing. But it's not clear what these big companies are actually benefiting doing with those retained earnings. And we've not sort of been able. That's the one place where we should be taxing potentially. Just recycle those. The surpluses. So it's also about a surplus deficit story here too that has to be looked at.
Yeah, and in one sense, it's not a problem that those retained earnings are just kind of sitting there, because if Apple were spending that money using up resources, then that would be fewer resources left for the rest of the economy. Now, there's maybe a problem in asset prices being distorted away from kind of where they would be efficient and what would correspond with efficient investment, financial investment, and kind of productive capacity, that kind of thing. So that's an issue. But in terms of money just kind of accumulating, yeah, if they spent it, that would be something we'd have to maybe tax. If they were spending it kind of in just wasting materials and other resources and that kind of stuff, then that might be something we would even more urgently want to tax.
Yeah, I think you're right, and I mean, there's currently the main way it's going is dividends potentially, of course, and I think some workers are benefiting from that. It's not showing up necessarily in wages across the board for at least that. Yeah, partly because there's not that many employees in general, so it doesn't really matter for wage growth in the bigger sense.
Yeah.
It would be interesting to see if Apple was much more like Ford, right? If they needed really hundreds of thousands of people to keep the structure going versus like the tens of thousands they really need currently. So that's that order of magnitude. Yeah, it's just
it's interesting too, because this is what we should want. We should want to be able, for our market economy to be able to give us stuff with the minimum amount of labor required, right? It's in some sense we have this nostalgia for a time when these companies needed a lot more workers or something, and maybe if you're relying on everybody getting their income from jobs, then it can be a problem if there are fewer workers. But on its own, it's like, oh, we don't need people to work as much. That seems like it's not a bad thing.
Yeah, I mean, ideally, you're right. I think in an ideal world, it's much more like Norway, where they're sitting on a bunch of oil, and everybody gets, or Alaska, everybody gets their sort of dividend from this public utility that we all share in, and then we can all. I mean, that would be a nice model if we could churn these huge tech firms into a public utility, and their earnings would then give everybody like $100 extra to spend or something a year. But that's.
Yeah, a generalization of that is that your economy has capacity to produce stuff for people, and you want to make sure that people have money to be able to claim that capacity or access that capacity. And maybe if you're in Norway or Alaska, that capacity looks like oil, and the oil can be traded for other things, but it's still kind of the same idea.
Yeah, I agree, and I think the key from Ford, of course, is the old story that he recognized that high wages go a long way. High wages, or just making sure that people have the means to consume and spend. I know you're not attached to the wage per se in terms of labor, but the fact that people have money, cash flow coming in is a huge part.
Yeah, there's a collective problem, a collective action problem here, right? Because Ford itself, even when they have a lot of workers, it doesn't really matter whether your workers can afford to buy your product, right? You want to pay your workers as little as possible and sell your product to the people who do have money. It's not, like in order for that Ford story, like I want my workers to be able to buy my cars, in order for that story to make sense. I mean, maybe that makes sense politically in terms of, optics and all of that, but it doesn't make sense. You're not, even if you're Ford, you're not influencing the macro economy at that level, right? So it's not just about, like, it doesn't really matter if you're for you, if you're Ford, it doesn't really matter financially if you're paying your workers enough to buy your cars.
Yeah, and I think in that sense, I think the interesting story there is that the wage immediately is right back. I mean, the fact that it's a cash flow question too. Like if each of your workers buys a Ford motor vehicle, yes, at least you have some way of creating demand for your own products. That's, I think, the story that was interesting back then. But if there's no money in the economy, if there's no demand, if people don't have disposable income, then it's also very difficult to have these massive investments to sort of say, okay, I'm doing something new and inexpensive or whatever that might be in the long run benefit us. But I agree with you. It's not a macro story. I think unless Ford really did. I don't even know that story that well because I just know that anecdote. But how many people really got those wages? How many people actually bought those cars? And how much did it actually matter versus is it an urban myth or not? I'm not exactly sure.
I think the actual kind of conversation with Walter Matthau when he said, how are you going to get the, or maybe I don't know if that's actually a different story. But yeah, I mean, I could imagine that it's worth it for marketing purposes to tell people that you pay your workers enough to buy your cars. And that from a business perspective, that may be a worthwhile thing to do. Or it could be that, they had to pay the workers a certain amount to get them to do the work. And it happened to be enough to buy the cars. And then you can kind of lean on that as a marketing tactic. And you actually don't have to pay your workers any differently. It just happened to be that was the wage or something like that. I don't know what the real history is though. Yeah.
Okay, so what do we make of this conversation? So we have, just going back to everything we touched on, I've been taking a lot of notes. So let's just quickly look at this one thing he said, which I'm just trying to figure out exactly what he means. Maybe we can figure that out.
Yeah.
He calls this new framework fiscal framework, which is a mix of fiscal and policy and QE. I'm going to try to figure out if he's wrote anything else here. Let's see. Nordvig fiscal policy.
Yeah, I mean, he's just calling it kind of a coordinated combination of fiscal and monetary policy. I mean, I think it's interesting because if the monetary authority really does have a mandate to maintain a stable price level, and they know how to do that, then whatever the fiscal authority does in terms of their taxing and spending, that's going to imply, along with other market conditions all taken together, that's going to imply a certain monetary policy position. And they're just going to have to do whatever they do. So it's always my sense that the fiscal authority is in the driver's seat, right? And then, the central bank does whatever they do to ensure price stability. Maybe that's a little bit of an oversimplification because they could maybe achieve that using a few different combinations of different levers or something like that. But if you're just thinking in terms of, we need tighter credit conditions or more expansionary, credit conditions, then In some sense, monetary policy is automatic. If you believe that central banks know what to do, know what they're doing, and know how to keep the price level stable, I tend to kind of lean in that direction. And they don't need to have, they don't need to be able to perfectly model inflation in order to successfully stabilize the price level. They just need to know which way to push the levers if they see pressure going in one direction or another. And I think they're pretty good at that.
Yeah.
Yeah.
So there's a Twitter thread on this question.
On this particular, on this question.
Yeah. Yeah. If you type in. So, and he's interesting. He's talking to Nathan Tankus, who I know well, and he's in the MMT crowd.
Yeah.
So there's a huge thread there. So, okay. So why is it important? Why is this fiscal important? First, if one macro policy operates in isolation, it can be contradicted by the other policy. This is especially relevant with monetary policy. In the past, expansive fiscal policy was often associated with monetary tightening, which is not good if you have spare capacity, low inflation. And he says policy coordination, which ensures that monetary policy and
Are you
market
reading from the
rates.
Twitter thread right now?
Yeah.
How can I find that?
Unfortunately, I'm on my iPad, so I can not really easily share it with you. But if you go to Jens Nordvig, it's on here. I'm just gonna shoot you an email.
Okay. So he's saying, actually, I'm going to stop my screen share.
Yeah. So why is it important? The first.
Right. If one macro policy operates in isolation, it can be contradicted by the other policy. Now, I mean, if the central bank is doing what they're supposed to do, then the only sense in which they would be contradicting the fiscal policy is if the fiscal policy, would have caused inflation or deflation, and then they have to kind of counteract that, right? And that, of course, that makes sense. Expansive fiscal policy would often be associated with monetary tightening. But it's also true that it's not good if you have spare capacity, low inflation, but then why would there be monetary tightening if you didn't have inflationary pressure?
Yeah, that's the point. And he's simply saying, okay, he's having an idea of full capacity, and QE pushes in one direction, and often we don't push in the same direction to achieve a goal with fiscal measures. Okay, fine. Policy coordination, which ensures that monetary policy and market rates are not fighting the fiscal policy, can help solve this problem. Coordination is good. Okay. There has in the past been a debate around fiscal multipliers. The notion that counter-cyclical monetary policy may work to reduce fiscal multipliers. This is a specific angle on this issue as discussed by the CBO, for example. Okay, so he's just giving examples of how the two policies contradict each other.
Yeah,
another way to think about it. Yeah.
If the fiscal multipliers are higher, that means you don't need monetary policy doesn't need to be as expansionary, right? So if the impact of the fiscal policy is greater, then you don't need as much help from the monetary side. I don't really know how much wiggle room there is here, right? Like the central bank has a mandate to just kind of counteract, at least on the inflation deflation price level side of things, whatever the the fiscal authority is doing. What I mean, like, it doesn't sound like he's asking for the Fed to cause inflation if the fiscal authority is doing something inflationary. So I don't know what he's asking for here exactly. I guess we should read more, but
I mean, the last thing is just saying that, just skipping all the way to the end, is that we should just expand fiscal monetary policy together. That's basically its conclusion of this thread. Just
well,
wondering
if you expand fiscal policy enough, then you don't have to expand monetary policy, right? And vice versa, right? So the fiscal authority gets to decide. If they say, oh, we want to be tighter, then that forces monetary policy to expand more. And if they say, oh, we want to like handle everything ourselves, then the monetary policy can stay tighter. So if you're saying you want both of them to be expansionary, then what you're saying is you want the fiscal authority to do half of your desired expansion, and you want the monetary authority to do the other half, right?
Okay, so here's the original thread that he's replying to, is somebody disagreeing with his blog post.
Okay.
Which
is
this
the Nathan Tankus stuff, I see.
Yeah, I disagree slightly with this conclusion, but still read Nordvig on how it's a myth that increases the money supply. Okay.
Being something, what's LSAP? Large scale asset purchases.
Yeah.
And fiscal expansion happening at the same time. Yeah, I mean, I agree that it's not really a new regime, and large-scale asset purchases, or QE, it does feel like it's unconventional monetary policy, but it does still feel like it falls within that realm of monetary policy of the central bank swapping assets, or expanding and contracting its balance sheet like a bank would. He says, if we're experiencing some upward price pressure, it's due to fiscal, not fiscal plus Fed. I don't know. It depends on how you define pressure and where you're drawing the line, right? Because hypothetically, the Fed is responding to pressure and pushing back in the opposite direction of wherever the pressure is to maintain price level stability. So
interesting. That guy is the host of Odd Lots, by the way.
Yep.
I now just recognize him.
He had an episode with Perry Merling on, by the way. I don't know if you saw that.
Yeah, I did. Yeah. Yeah, I mean, okay, this is not that insightful in the end. I think we're more interested in the actual mechanics anyway, and they're sort of waving their hand at a high level in this Twitter feed.
So Nathan Tankus is saying that he's kind of calling into question the idea that bond sales are deflationary, which is interesting.
Yeah.
I get that's kind of an MMT take. I think I don't agree with Nathan Tankus on that. Right. Yeah. I mean, I think I agree with Joe Weisenthal here. Monetary expansion is fine. Fiscal expansion is fine. Both stimulating at the same time is also fine. But don't think there's something special, something extra special that happens when they're both rowing in the same direction. Yeah, I think that's right.
Yeah, we're not in a new regime, I guess, either. There's nothing really. I mean, the new regime happened already, and I think it's much more impactful to say there's swap lines. I think that's the revolution versus purchasing programs. I think that's for me, that swap lines is a completely new architecture. and this is trying to manipulate behavior in the economy. And the most severe, the primary function of a central bank, of course, is to provide liquidity. And if the central banks have expanded the liquidity networks, that's a much more significant development, and somehow a regime in which now fiscal authorities are somehow doing something in tandem or not with monetary authorities. Yeah, I agree.
The central bank cooperation and swap lines, you're moving toward a more globalized institutional framework. So that does feel like an evolution. But I guess that doesn't really say much about the inflation stuff.
No, it doesn't. Yeah, the reason, I mean, just to backtrack on that, because the central bank, or at least in the US case, was all completely in the overnight market, right? And the reason they're going into the longer run markets, QE, is to influence this inflation, right? So we're trying to get it into the markets where we might be impacting an inflation conversation potentially.
I don't know if the purpose is to influence inflation. And originally when we did QE, Ben Bernanke didn't even want to call it QE. He wanted to call it credit easing or something like that, I think. I mean, to some extent, there's the story that Perry Mehrling tells about how you have this transmission from overnight rates to kind of the money market to the capital market. But there's also, and then that broke down. The transmission mechanism broke down as the markets broke down. But then there's also the question of just, do you want the markets to be functioning? Do you want them to have prices? And I think when you have a financial collapse like in 2008, then that's kind of what you're backstopping. I don't know. Certainly, if we allowed the financial sector to collapse, that would cause deflation. So you can't separate these two things exactly. But it's also not just like it's not just adjusting levels of things, right? It's you're backstopping the market. You're setting that outside spread so the market can function.
Yeah, I agree with that completely, and that's also what I was trying to say. Like that's the interesting thing about swap lines, because it's expanding this really core capacity of a central bank to address liquidity. Because liquidity, the lack of or the absence of liquidity could mean that there is actually no market at all. We're not talking about there's no price. So the fact that we have liquidity there, it ensures that we create some floor or some sort of, what we assume in the Badger terms, a price that otherwise might not exist. And the fact that the Fed and other central banks are cooperating to expand into the places where they might now be important and relevant is the big architectural update of the crisis. And now that the Fed is sort of now venturing out into other territories, ineffectively, as we're seeing, and not just the Fed, but also but previously the Bank of Japan, and also now the ECB and other central banks, just shows that this is you can't really solve whatever the objective is, stimulate growth, whatever, purely but with these tools that are available. And I think that's just a very clear lesson. I think if I understand correctly, your sort of intuition is very similar to what Perry would say. I think he's been saying something similar, which is to say, well, look, QE1 was actually the backstop, as Stefan said earlier. It was the actual backstop. We made sure the markets didn't fall apart completely, didn't freeze. But QE2 and the following ones were departure from this complete backstop. It was now trying to induce growth, right, and try to get people from holding one type of asset into holding a different type of asset, and that was the attempt. And you could do that with a different type of policy. There are other options available if you think about it to create that. Then we're much more in this sort of more tighter money potentially at that level, but really supplemented with actual cash flow coming from a fiscal authority in this case. And then we're also in a place where we have better prices, right? Because in the world we have right now, it means that the Fed is the counterparty half the time, instead of private actors really having price discovery, and we're really making sure that whatever is out there is actually wanted, not just because there's a big actor here holding it or wanting it. So where there are distortions, I think that Perry would point to that, of course, other people are not seeing or not agreeing, or we don't have the framework to appreciate that point enough, partly because, yeah, I think Perry attached a lot of value to the price discovery aspect, and I think that's currently not being done by the Fed at all. Like, low interest rate environment does not induce that.
There's also the facility that the ECB announced in 2012, where they would they promised to buy up sovereign debt if the countries asked for it, and that never got used. It still hasn't been used today. But it still helped stabilize things because they knew that the ECB was standing ready. So the ECB was the counterparty 0% of the time and was still able to kind of backstop things.
Yeah, I think that's also going to be the hope for the swap lines. I don't think anybody really wants to use them. I think politically it's still problematic in the future when all of a sudden, oh my God, X country, and where do you draw the line? All of a sudden you have to decide, is Brazil really worthy, and a new regime or whatever. But fine. Yep. When they're in place, actually, that was one question I had in the previous meeting in another group that we had in the reading group, was whether or not a country like Brazil, now having a swap line, could it credibly just expand its own credit, promise to draw on the swap line, for example, instead of actually drawing on the swap line? Would that be enough to just expand, create another asset class in the middle, right underneath the swap line, right, without actually drawing on it? I wonder if that actually might work or not. That would be an interesting experiment, because then,
yeah. Well, I should probably get going, but I just wanted to quickly bring it back around to this article. So near the top, he says that the myth is a myth about a simple link from money to inflation. And I think if you define money as specifically the money stock as defined by a particular definition of what counts as money and what doesn't, like say base money or something like that, like how much base money is there, then yeah, there's no simple link. But there is a simple link between money and inflation if you're thinking of money as, oh, well, how much money is being spent on, the productive output of the economy, on consumer goods, then yeah, there's a very straightforward direct link between money and inflation. It just depends on which aspect of money you're looking at, I suppose.
Yeah.
Yeah.
Well, it's been an interesting conversation today. So next week we'll just continue with what Stefan suggested.
Yep.
I'll be happy camper.
All right. Thanks, Jay.
Cool. Enjoy the session later.
Thanks.
Good luck. Bye.